Hi, everyone. This is Oghoorian with ACap Advisors and Accountants. We are a fee-only wealth management firm and a full-service CPA firm. Thank you again for joining us for another edition of a webinar. And in this case, we're going to be talking with Kevin Berson about how to value your business and maximize your selling price. Now, Kevin is with Seapoint Business Advisors. He is a mergers and acquisitions advisor, an M&A advisor, and he works exclusively with business owners who are trying to sell their business. So if you are a business owner and you're trying to figure out a way of how to get to the point to sell your business and you want to get the maximum value as possible, Kevin is the person to deal with. And this is a phenomenal presentation for you to get some insight on how to prepare for that ultimate sale. Or if you are a buyer of a business or you're thinking about buying a business, this presentation can also help you in identifying, what types of things to look at when you're thinking about buying a business, whether if it's multiples or certain key EBITDA numbers or anything financial related, you'll get some insight. Now, Kevin is also a really good friend of mine as well, and he's a really good person. We play tennis together. He beats me all the time. He's a great tennis player, so I won't hold that against him. Before we kind of head on and hand over to Kevin the reins of the presentation, I want to do some little housekeeping. This video is being recorded. We are going to post this on all of our social media channels. So if you don't get a chance to listen to the entire thing or watch the entire thing, don't fear. We're going to post it on our website, on our YouTube page. There'll be plenty of opportunities to ask questions during the presentation, and also at the end, you can also post them on our comment section. There's a section on the presentation where if you have a question, you just click on that. We're going to get to all the questions at the end, I promise. And without further ado, let me go ahead and introduce Kevin Berson.
All right, thank you, Aura. I appreciate it. I'm really happy to be here. So a little bit about me before we jump in. I have a consulting firm called Connected, which I founded in 2014. And this firm, the purpose of the firm is to help clients prepare to sell their businesses. So I will get involved 2 to 3 years before they're ready to sell and help work directly with the business owner to help increase valuation. When it comes time to sell, we do all of our transactions through a firm called Seapoint Business Advisors. The firm's based in Westlake Village. However, I have an office in Encino. And we work with businesses that typically sell between 2 and 100 million. We have a very high close rate relative to others in the industry. My close rate's over 80%. Compared to about 50% for the industry average. Prior to working in M&A in this lower middle market space, I have about 20 years experience starting at Arthur Andersen in consulting. And then I went over to Technicolor after the Enron fiasco in 2002, went over to Technicolor where I spent about 10 years there. And that's when I got involved in mergers and acquisitions. We did some very large deals at Technicolor, including selling the billion-dollar division of RCA. And I went to my undergrad at UCLA and business school at USC, but my sports loyalty is definitely to UCLA. Okay, so now let's get into it. Okay, so Seapoint Business Advisors, what are we and who do we serve? So we serve there are business brokers that typically will work on what are typically referred to as Main Street transactions. Those are, retail and restaurants and small businesses that sell under $1 million. And then there are large investment banks that will typically do deals well over 100 million. So Seapoint serves that large space in between. We provide a very high touch service. We provide the expertise of investment bankers that work on much larger deals, and I have that experience from my time at Technicolor, working on Fortune 500 M&A deals. And our model is pretty client friendly because we typically only get paid when we complete a successful transaction. So it's kind of analogous to the real estate model. And we will also provide business valuations, which are opinions of value, and some consulting services where I use my consulting firm Connected as well. So that's what we do. So the first thing I wanted to cover was, how do we create an opinion of value? I think it's really important for business owners to understand how the high level process of how we arrive at value. So what we do is we start with at least 3 years of financials. And I'd like 5 years if possible, because I really want to understand all the trends that are happening in the business over an extended period of time. And the first line that's highlighted is the net income. So that net income of the business becomes the starting point of the valuation. Some business owners have been told that their businesses will sell on a multiple of revenue. That is sometimes the case, but usually not for the businesses that I work with. When businesses will sell on a multiple of revenue, those are typically very fast-growing software as a services type software businesses. And that's not what I'm talking about today. I'm talking about more traditional businesses that have been around for 5+ years and have some stability to the business. So we start with the net income, and then we will add all the adjustments to net income. And these adjustments will include what the owners typically pay themselves in compensation, depreciation, interest expense, taxes. Often business owners own their property that they're in, so we have to make an evaluation of the market rent. Sometimes business owners will under or overpay rent for tax purposes, so we have to evaluate that. And after we add all these adjustments, you come down to the bottom where we have adjusted EBITDA. And this represents earnings before interest, taxes, depreciation, amortization, and other expenses in the business. And a lot of times this is a discussion that I need to have with the owners, and sometimes there's some personal or family expenses that are in the business. I've seen private school sometimes being run through the business. I've seen mortgages on second homes. And my role is not to be a narc for the IRS here. I'm just trying to understand the adjustments that can be made, because they will benefit the owner in a sale. All of these expenses, if they can be proven, can be legitimately added back to the earnings to come up with this adjusted EBITDA number. So
Kevin, can I ask you a question about that real quick?
Yes.
So do you do common size income statement or financial statements where you say, this line item as a percentage of your revenues or expenses, typically for your industry should be 10%, but you're above that. So trying to get explanations for that, or advising the client or the business owner to maybe reduce that as they get prepared closer to the sale date?
Yeah, absolutely. And we'll get into that in the next section. We talk about
okay.
It's a great question, though. We'll get into that once we talk about the industry multiple. We'll do benchmarking against other companies, and we'll typically want to see how much the cost of sales compares to others in the industry, and the G&A expense. So yeah, that's absolutely part of the multiple. So the step one is really, what are just the earnings of the business? And we like to look at a 3-year average. So in this example here, we have a 3-year average of 720,000, 860,000, and 1.15. So then what we do is we'll take a weighted average of those years, and there's different ways to do a weighted average. I like to use this simple weighted average here, where we put a priority on the most recent year. So in this example, the most recent year, the 1.15 million, we're going to give that a 3 times weighting, the 860 2 times weighting, and then 3 years ago, the 720 will be a 1 times weighting. So if you take a weighted average of those, the earnings are 984,000. So that becomes very important as we get to the next step. Okay. So the next step is finding the multiple. So different businesses will sell at different multiples, and the multiple is typically a measure of risk for the buyer. And I have a page coming up where I can share some examples of different multiples in different businesses. Typically a business with a lot of recurring revenue that's growing quickly will have a pretty high multiple. and a business that has a lot more risk to it, typically restaurants, retail, health clubs, have a lower multiple because they just tend to be riskier. And there are databases that we can look to get a sense of what these industry multiples are. So for every deal, I will look at least 3 different databases to come up with the multiple. So that's step 2, is we take a look at the multiple. There's also a premium on the multiple for size. So once a business hits about 2 million in earnings, the multiples will increase. And then once it hits about 10 million in earnings, they'll increase further. And most of the multiples that I work with are businesses that are typically between, I'd say, 3 and 7 times EBITDA is very typical. When you get into larger deals, over 7, 8 million EBITDA, then the multiples will increase again. And now we're talking about 8 to 10 plus times. And when you see a PE ratio, yeah.
I have a question. On the multiples, what kind of multiples are you seeing on professional service firms, like CPA firms, financial advisory, the law firms, those types of things?
Yeah, well, we'll get into that in a second. I have a talks about that, but those tend to be at the lower end of the scale because they're typically very very tied to the specific people in the firm, and they need those people to continue to operate. Service-based businesses, all things being equal, tend to sell at lower multiples because there's so much personal goodwill attached to the business. So we can talk about that, and we can also talk about deal structure. Okay, so step 2 is finding out the right multiple. So we use different databases to come up with what we think the right multiple is. And then step 3 is we will multiply the weighted average earnings times the multiple, and we will use some judgment to adjust that multiple, and we will potentially skew that multiple up if the business is great and the macro factors are very strong. And conversely, the multiple can also be detracted if, for example, this was an online retailer company that has done really well about 7, 8 years ago, but in recent years, there's Amazon and eBay have entered the market, and its customer sales are declining, and retail has just become a lot tougher. You'll see lower multiples for those kind of companies where the macro factors are not as favorable. Other reasons to make adjustments to the multiple are for if the team doesn't have a lot of depth. For example, if the seller is really running all aspects of the business and they don't have a team in place, then that business is not going to sell at the full multiple either. Other reasons why a business may not sell at the full multiple is if there's a lot of deferred maintenance required if they have some really old equipment and a buyer would reasonably have to replace that equipment. That will detract from earnings and potentially the multiple. Also, if the seller is insistent upon all cash, that's going to be a tougher deal to get done, and I think that could also play in. And the last factor would be what's the likelihood of transferring leases and contracts. If there's a really short-term lease involved, like say the business only has under a year left on a lease, that's going to be a tough deal to get done because the buyer's probably going to need to move, and there's going to be cost and a pain factor involved, and that's going to make this business a little bit less liquid. So in summary, the step 1 is coming up with the weighted average earnings. Step 2 is identifying a multiple, and step 3 is multiplying step 1 by step 2, and then making an adjustment based on some of the qualitative factors around the business. Okay, so here's some examples of multiples that we see typically. As I mentioned, most of the deals that I'm working on are going to be 4 times plus EBITDA. So if you look in that on the left, what is a business that sells under 4 times? Well, this is going to be kind of a Main Street type business. They tend to be really small earnings, under a couple $100,000 in earnings. They're really low growth businesses. They're low barriers to entry. It's pretty easy for a competitor to open up a competing business. there's not a lot of, like, as Warren Buffett would say, like a moat around this business. There's not a lot that's defensible here. These businesses typically don't have great financials. They don't have great processes in place. So those are typically, under 4 times. And most of the deals that I'm looking for are these, 4 to 6 plus times. And these are businesses that have growth. They have financials in place, and having good financials in place becomes absolutely imperative to selling a business. A business will not sell if a buyer cannot get a buyer and his team of advisors. They need to get very comfortable with the financials of the business. They're going to undergo weeks to months of due diligence. So my goal when I'm representing a seller is to make sure that all the books are very tight, well prepared, reconciled to tax returns. Any trends can be explained. If you can do that, you're much more likely to sell at a higher multiple. What's a business that sells for over 6 times? This is going to be a very high growth business. For example, one of the opportunities I'm pursuing is an enterprise software company that does security software, and it's a lot of recurring revenue. They have customers that are paying monthly recurring fees, and those are very, very scalable businesses, and those will tend to sell at higher multiples. And the next page, I go into some, a dozen or so examples of recent projects that I've worked on. At the top of the list is one that I'm working on getting ready for market right now. This is an e-commerce company. E-commerce has very, very high margins. And this one is going to sell, we think, around 8 times or higher, just given the growth. I mentioned the IT security company a couple lines below. Another one of interest is a label printer that focuses on apparel. They do like tags, clothing tags. This one is worth about 5 times multiple. Really, given the scale here, this is about $5 million of earnings. But this one, you'd have to make an adjustment given the industry. We take a close look at who are the customers of the business. And if the customers are major retailers that are not doing well, then we'll have to make a manual adjustment to the valuation. Going down the list, a smaller label printing deal that sold about 3 times EBITDA, a commercial paving company about 3 times. And then Aura, towards the bottom of the list, we kind of see an eviction law firm and an environmental consulting firm. And those sold at about 2 times EBITDA. And that's because these are so reliant on the personnel and the personal relationships that can tend to be tricky to transfer. So and also the other thing to keep in mind on those kind of deals is it's pretty rare to see all cash in those deals. What would be pretty reasonable would be 40 to 50% cash down at closing, and then the balance of the consideration will be paid over 2 to 3 years, assuming that contracts transfer over, clients transfer over, etc. Any questions so
far? No, that makes sense. I mean, I think you're right with the professional firms. The real human capital there is the principals, and if they leave, there's a big risk of those clients leaving as well. So it makes complete sense. It's just interesting seeing all these really high multiples on the e-commerce and especially the wastewater engineering. I mean, I would never expect that to have such a high multiple.
Well, that one was so unique because they are one of 2 players in the country that offer these services. They have a tier 1 client list, Fortune 500 companies, and it's really a niche. So a niche engineering firm, a niche manufacturing firm will have a premium because they have, there's very few companies that can do what they do at this scale. So this one was really, really interesting.
It's that moat you were talking about.
Exactly. Very, very strongly positioned in the market with tier 1 client list.
Perfect. Okay.
Okay. So moving forward, the next slides talk about, well, what can you do to increase your multiple and your valuation? So what I want to see when I take a business to market is I'm looking for a business that is at worst stable, but hopefully growing. If a business is stable, that's great. Buyers are going to like that a lot. It will demonstrate some consistency. It will demonstrate that the business is working. The business model is working. And if it's growing, even better, it's even easier to sell. However, if there's a decline in the business, and I see this a lot where a business owner will call me, and the last couple of years have been materially worse than the previous couple of years. Those are very, very, very difficult businesses to sell at reasonable valuations because the buyers are just going to assume the worst. And the seller has to really have an amazing story for what happened in the business. So those are really tricky situations, and the seller needs to be very reasonable in valuation and also very reasonable on terms. If the business is not performing well, then it's very likely there's going to be some kind of earnout, which means that part of the consideration will be paid based on a business performing to certain predefined objectives. So that's number one, is the business needs to be pretty healthy. Number two, the business needs to thrive beyond the owner's direct involvement. So I use a test for this one. The test is, can the owner take a 3-week vacation without the business falling apart? If the owner can do that, then that's an amazing sign. It means that there are key team leads in place. It means that there are processes in place, and the business is very well prepared. Certainly there are businesses where the owner might not be able to do that, but I'm really looking for a test here that really to make sure that there's some bench strength in the business, that the owners have other people to rely on, so they're not single-handedly doing everything. Because if they are, it becomes a problem for the buyer. Who's going to take over these functions, assuming the seller doesn't want to stay in the business. So that's something I really look for. And then number three is what I talked about before, is the books have to be really clean, well prepared. They have to make sense. They have to tie. Balance sheets have to balance. I have to understand any major trends. If the gross margin is increasing or decreasing, I really need to understand what's happening in the business, and the trends need to be explained. And then it becomes very important that if there's any personal expenses in the business, I talked about personal travel, meals, I've seen child support, I've seen private school payments, all of these expenses, they're okay as long as they can be proven. They may become a challenge for if you need to go get SBA financing or you need to get financing from a bank. The bank's not going to give you credit for those unless they can really be proven. It just becomes trickier. The more personal expenses in the business, it becomes trickier to get bank financing. So
and just to echo on the clean books part, I can't stress that enough either. I mean, sometimes we come across people that have really, really poor financial statements, and it's a real challenge and very laborious to go through that and fix that, especially over several periods.
So exactly. So what we'll do, and when we come in, we're meeting with the seller and we see some financials that are out of line, we will strongly encourage them and insist that they get a good CPA in there to clean up the books and make things look reasonable. For larger businesses, and when I say larger, I'm talking about a business that's around $1.5 million EBITDA and above. We are now insisting that businesses hire CPAs to get the books on a GAAP basis. Sometimes we see financials that are on a cash basis. If you're doing that, then you're not necessarily optimizing the financials. A buyer at this level, a private equity buyer, a strategic buyer, they're going to want to see GAAP-based financials, and GAAP is generally accepted accounting principles. So that's something that we insist on for larger deals. And once we get to a certain point on a deal, we're talking about $3 to $5 million plus EBITDA, then we will recommend another layer of preparation, which is typically a quality of earnings report done by a third party that can really go through all the numbers as well and put a third party opinion together. So we're doing that on some of our larger deals as well. A couple other things to keep in mind. Any business that has some significant dependency issues, that's going to be a challenge. Like, for example, if you do more than 50% of your sales to 2 customers, this is called customer concentration. And that a buyer could perceive risk there. So say you have a couple amazing customers, they've been with you a long time. You're gonna, as a seller, you're gonna really have to make a really strong case to the buyer that these customers will transfer over. And this always becomes a major negotiating point for buyers when you have such extreme customer concentration. So we like to see, if possible, the largest customer not representing more than like 25% of sales. That's ideal. I realize in some industries that's not always possible. I recently did a deal in the aerospace parts business, and there's only so many customers you're dealing with. There's about 10 major customers. So it's very, very likely you're going to have some customer concentration in some industries. But what's important there is to be able to show that you have a backlog or customer contracts, so the buyer will feel very confident that this work will continue. That's customer concentration. The same thing applies to vendor concentration and employee concentration. If you have, one key employee that's so tied to the business, that can also present risk to the buyer. So we need to carefully make sure that the employee has some, we would recommend that the seller have retention agreements with key employees to make sure that they transfer over in these cases as well.
I've got a question about that, Kevin.
Yeah.
So does the new employer, does the buyer end up signing new employment agreements or contracts with the employees, or do the existing employment contracts transfer over? How does that work?
That's a good question. So there's typically two major ways to do deals. There's what's called a stock purchase agreement and an asset purchase agreement. In the stock purchase agreement, the buyer is buying the entire stock of the company, in which case, basically on the day of closing, the buyer takes over all aspects of the business financials, and the employees become immediately new owners of the buyer. Most deals that we see are asset purchase agreements, where the buyers are buying select assets of the business only. And in this case, the employees are terminated from the seller, and they are given new employment agreements with the buyer. It's typically a cleaner way for deals to get done, because the buyer doesn't inherit any of the past obligations of the company. They start fresh with select assets. But this is a little bit more of a complicated discussion, and we definitely there's tax consequences of how this is done. So we definitely encourage the principals to work with their CPAs as part of this process.
Okay.
So another point is really want to make sure that the owner has reasonable expectations going into a process. So my goal and my objective is to come up with a valuation that I can support with market data that I feel pretty confident that I can support. But I'm talking about the price, and I'm also talking about the terms. It's very rare. It does happen sometimes that businesses sell for all cash, but most deals that we see, I would say that 10 to 20% of it will involve some amount of seller financing, and we'll ask the sellers to carry a little bit of paper on the deal. It does a lot of things to help make deals happen. It will show that the seller is invested in the buyer. The seller supports the buyer. The seller is going to be around to help the buyer in case something comes up. It also makes it easier to get financing. There can also be some tax benefits for the seller in doing that. And it just really creates a much better environment for a deal to get done if the seller is a little bit flexible on the structure and willing to carry a little bit of paper. And I have a note here that say about less than 25% of deals are all cash. So
with cash is so cheap right now that it doesn't make sense to kind of, do all cash. I mean, you can borrow it at such a low rate, and if you have a growing business that you're buying, you're basically arbitraging that difference.
Right. Yeah, buyers will definitely want to use leverage, but what I'm talking about here is seller financing, where the seller will carry a little bit of paper. The seller can get basically a market or above market interest rate on that loan, and it also just really helps create a real friendly environment to get a deal done. Couple other points is it's the seller will need to expect to sign a non-compete. A buyer is not going to buy a business and then have the seller go start a new business, the same business across the street after they sell. That's not going to happen. So we need to coach our sellers that they need to sign a non-compete. And these are typically about 5 years. The other thing is that the sellers will typically need to stick around for 6 to 12 months after closing. And typically this is on a consulting basis. Okay. The other part of this is that when I'm coming in and I'm talking to a seller, I want to make sure that they have the right team of advisors around them. And this is typically a really good CPA that can understand the financials and help clean them up. A good corporate attorney that has done a wealth manager is also part of the team. They're gonna make sure that the seller's assets are well invested after the deal. Bankers, and these are commercial and SBA bankers to help make sure that loans can get done. And I play the quarterback role as the M&A advisor in this process. Okay. All right, last page is I can't underestimate the psychology of the deal. The psychology is incredibly important. These deals are all, even the cleanest deals, they tend to be roller coasters. There's a lot of emotions. There's a lot of different phases of the deal. So it's my job to be a part therapist in this and work with the principals and kind of remind them of where we are in the process, how we got here, and keep us focused on the big picture.
I mean, it's understandable if someone's kind of built
often
over
sellers
20, 30 years.
Yeah, absolutely. These businesses are often like children to the sellers. So they're very emotional about these businesses. And, these deals, when you get an offer in, that's a great first step, but there's still a lot of work to be done. Then the due diligence happens, and that's when the heavy lifting happens. So that's when the seller will go through a complete examination of all aspects of the business. It's a little bit of a proctology exam where at this point, any question's a fair question. All the books will be scoured, and everything that has been presented will need to be defended and proven out. And that can be a pretty stressful process. I play a major active role in managing that. I play a buffer between the buyer and the seller, and make sure, and I try to take as much of the heavy lifting off the seller as I can to just, I should be able to answer most of the questions myself with all the preparation that we've done. But what I want to do is just really filter the request to the seller in a way that is, really keeps things moving and on track. What else was I going to say about that? Yeah, I mean, the seller has a job. Yeah, I was just going to say one thing quickly. The seller has a job in this process, and that's to keep the business moving, to keep the business performing at the level of where it was when the buyer made the offer. If the business deteriorates, loses a key customer, loses a key employee, that becomes an opportunity for the buyer to potentially ask for an adjustment. And we don't want that to happen when we're in a deal. The seller's job is to keep the business moving forward, progressing, and keep the earnings at the level where they were where the buyer made the offer. That becomes really, really important. Sorry, yeah, go ahead, Ara.
No, I'm glad you finished your thought. Basically, my question was, are there provisions in place? I'm sure there's got to be some sort of provision in place where, let's assume a business owner sells their business, but part of the contract is they're going to stay on for another 6 months to help with the transition. But during that 6 months, maybe once they've already got their money or they've already mentally, maybe if they've checked out, are there provisions to ensure that person does not get mentally checked out and they're still committed to making sure that deal gets done and they're not jeopardizing the future value of that business?
Well, so that becomes tricky, but yeah, I mean, typically the buyer will want the seller to stick around for a period of time and have like kind of key responsibilities outlined. So there will typically be a consulting agreement where the seller will have to do X, Y, and Z. And if there is an earnout provision, there may be additional requirements of the seller to help be involved. Like typically, I have one deal where there's an earnout where the business has to remain at a certain level of sales. So the seller had a responsibility to stay on and kind of support that and attend meetings as required to be able to get those additional earnout payments. So
Okay.
yeah, that typically comes in the legal side of this, where we like to work with really good corporate attorneys that understand these M&A transactions and can really write up these agreements to really protect the buyer and seller and kind of come up with a reasonable compromise.
Okay, great. Should we move on to the Q&A part? Or?
Yeah,
okay.
I think that's about all I have prepared. So yeah, I'd love to take some questions.
Okay. Let's go to the Q&A part. So the first question we have is, how long does this? I mean, it seems like a pretty laborious process. How long does the entire M&A process typically take? I know that's a loaded question because every deal is different, but on average, how long does this typically take?
Yeah, I'd say on average, it's 6 to 8 months typically, and that's 6 to 8 months after we sign our representation agreement and we start the process of preparing the marketing materials. I've had deals that have closed in under 3 months, and I've had deals that have taken 2 years. So it's a pretty wide range, but I can say the better the business is performing and the better the marketing materials are prepared, the higher probability of success and in a pretty rapid process. The last couple deals that I've done were about the aerospace parts deal that I did was 5 months from start to finish. And that included 2 months for the SBA loan process. And that one we had, over 10 buyers involved in that one. We were able to move pretty quickly.
Wow, that's interesting. So it's kind of speaking of the buyers, what kind of buyers are you seeing? I mean, are you seeing companies that are trying to get vertically integrated? Are they, trying to grow by expansion, or are these like, private equity firms trying to add to their portfolio? Like, what is the composition of these buyers?
Yeah, it's really all over the place. So, and it really kind of depends on the deal size. So I'll give you a couple examples. So the aerospace parts deal that I just did, the buyer for that one was a guy that had been president of another aerospace parts company, and he was acquired by his previous firm was acquired by a private equity firm. It was not a good fit for him going forward. So he was an individual buyer that had some enough net worth to get an SBA loan, and he was able to buy this business. The environmental consulting deal that I just completed, it was a private equity buyer that has other similar companies, and he added this to his portfolio. The e-commerce company that I'm looking at, it's pretty large. The likely buyer for that one will be a large private equity firm that has other apparel brands, or potentially a strategic buyer that has multiple apparel brands as well. And they can leverage, some of the shared services in terms of, marketing expense, finance expense, and distribution costs. So it really depends on the deal size and the industry. But yeah, we really work with all three major types of buyers, which are individuals, private equity, and strategics.
So what are you kind of trends are you seeing in the marketplace right now? I mean, some people are talking about a recession in next year or some kind of a slowdown. Are you seeing anything on your end? I mean,
I'm really not. I think when if a business is very strong and the earnings are really good and it's easy to understand the story of the business, then I'm seeing a lot of buyers come to the table. There's a lot of money on the sidelines. I think private equity firms now have something like $3 trillion that are in funds that need to be invested. So there's a lot of money in private equity that needs to be deployed, and there's still a shortage of there's more money than good deals. So the valuations are still getting bid up, and it's still a very, very healthy market for the deals that I'm seeing.
Wow, that's incredible. What you say, 3 trillion? Is that?
Yeah.
Oh my goodness, that's a lot of cash on hand. Wow. So I guess the next question we have is, what are some of the typical buyers that you represent? And we talked about the typical types of companies that you represent, but I'm assuming you also represent the buyer's side as well. What are some of the buyers that you're seeing?
Yeah, we do. I'd say 90% of what we do is sell side work, where we have exclusive mandate to sell the business. You know, I have done a little bit of buy side work, and I will do some buy side work when it's an industry that I have some contacts in. Typically, if it's a corporate buyer where, you know, they have a very specific thing that they're looking for, those type of searches we will get involved in. But most of our work is representing sellers. That's really how we typically work.
Okay. Well, Kevin, I think that's all the time we have for questions. I want to thank you for being part of this and agreeing to do a webinar with us. I appreciate it. This is Kevin's contact information. We'll also include that in our information, part of our YouTube and everywhere else we publish this. So if you have a business and you're thinking about selling it, even if it's 2 or 3 years from now, you want to get ready now to prepare your financials and your business to get to the point of selling it, contact Kevin. He's a phenomenal resource. I'm sure Kevin will even tell you now is not the probably good time to sell. You may need to do X, Y, and Z before you get to the point of even going out there and entertaining buyers. But reach out to Kevin. He'll definitely help you out in that respect.
Thanks again. I really appreciate the opportunity to be here.
Yeah, thank you. Take care, everyone.